And we now bring in from a Pacific Investment Management Company in California, we welcome Bill Gross and Mohamed El-Erian. Gentlemen, good morning.
Thank you, Tom.
Hey, Tom. I want to talk, Bill, first of all, about your research note. And if we could bring the research note up, folks, you can see this at Pimco.com. And it's Bill Gross writing on Stan Druckenmiller leaving the market, of course, the famed hedge fund manager. And I love what you said, Bill. There is no 8% there for pensions, no stock returns to get to 12%. Mohamed El-Erian, Bill Gross investing in bonds is at the ball out of the park the last 2 years. How tough is this going to be, Dr. El-Erian, in the next couple years?
It's going to be tough, Tom. I think that the markets are adjusting to the reality of a lower growth outlook, to what Bernanke has called unusual uncertainty, and also the need to worry about your downside. So, as Bill put in his I.O., it's going to be very difficult to generate the sorts of growth and returns that are assumed in lots of pension funds and insurance companies.
Bill, as you know, and you and I have talked about this before, you've got a Sharpe ratio, the measurement of your risk to reward to risk taken of a 4, which is, folks, that's a once-in-a-lifetime thing. I mean, it's just an outstanding statistic. How did you do that over the past 24 months?
Well, it comes from what we call safe spread, Tom. I mean, a safe spread is basically not beta, but alpha generation and high information ratios, as you suggest. And, you know, the objective is really to find that particular asset or asset class that generates a high level of income, a low level of risk, and a low level of volatility. The numbers would suggest that we've done that pretty well over the last 24 months. We look forward to it for the next 12 months as well.
Here recently? Have you gone to an international perspective like Mohamed's Brazil, or are you looking at playing with agencies of the sovereign space in America?
Sure. I think our new normal thesis, which suggests low growth in the developed economies and higher growth in the developing economies, suggests that you move not only for risk assets, that would be equity and even emerging market high-yield bonds, but also for low-risk assets, and that would be currency-related. For instance, Brazil offers, yes, perhaps an overappreciated currency, but also a real rate of interest of 8 to 9%, and that's quite attractive. So we're looking to high growth economies in both fixed and equity space.
And to both of you, and speaking with John Bogle this morning, the legend of Vanguard, I hate to say this, Mohamed, but he said way too many kind things about Bill Gross. And, you know, there's a guy, he's an index fund guy, and he said, you have just done this year after year. What is the methodology that you've done in investment, whether international or domestic funds? What is the methodology that's allowed you to be distinctive among active managers and get it right more often than not?
You know, Tom, I got to see Pimco from your coast, from the East Coast, for 2 years, and I got to compare Pimco to many managers that were coming through Harvard offering either to manage our money or actually manage our money. And I kept on asking that question, what is it? And I would suggest a few things. One is that there is truly a global approach. So the question is not, is Pimco limited to certain markets? The question is, where is the best risk-adjusted return offered? Secondly, a tremendous amount of effort has been made to create a culture of second-guessing, of questioning. For our investment committee, there's a shadow investment committee whose job is to second-guess the investment committee. There's a lot of openness to the outside, to what people are saying on the outside. And then thirdly, importantly, structure. Structure is really important because it makes you ask the important question. And I think that if you were to model Pimco's consistent outperformance, these factors would come out as having a lot to do with it.
Well, let's switch to the international view here now. I want to bring up a chart. This is too much information, folks. And guys, this is a chart you guys have tattooed to your brain. And this is Korea, folks. This is a Korean won, and you see the emotion over there on the left side of the chart, which was a crisis of 1997. And then you see the improvement in Korean won, and then in the crisis of 08-09, a weaker Korean won. And gentlemen, as you know well, boy, has Asia done better. And with IMF meetings this week, Bill Gross, how critical are these IMF meetings, and how ascendant is Korea and Asia right now?
Well, I think they have a right to be offended if, in fact, they are. You know, they deserve a higher representation in the IMF. That's what they've been, you know, struggling for the past several years, and it will probably take an additional number of years for them to gain equal representation or pro rata representation relative to their economic strength. But, you know, Korea is a powerhouse. They've gotten a lot of orders recently in terms of exports to China and to Europe. Their currency, as you noted, is related to some extent to inflation and to the dangers, I suppose, of a North Korean type of flare-up. But in any case, Korea is representative of very strong emerging market currencies which stand in contrast to the U.S. dollar.
Mohamed, you've been at the IMF. Would you please explain to me why Belgium has such a large vote there versus Korea or Singapore, or for that matter, China? When is this going to change? I mean, it is a bit of a ballet this week in Washington. There's a silliness to it at one level.
There is a silliness. Tom, neither the world of today nor the world of tomorrow can explain your question about Belgium. What explains the question about Belgium is the world of 1946, and it speaks to an unwillingness to give up historical entitlements. It's very important for Europe to realize that unless it does so, the IMF cannot be as legitimate and the IMF cannot be as effective as it needs to be at the center of the system. Like Bill, I unfortunately also believe it's going to take some years. These things should change much more quickly, but no one likes to give up entitlements, and Europe certainly does not like to give up its historical entitlements.
Well, it's been an exciting week in Europe. Let's bring up, if we can, Rex, Greece-German spreads. This is a story the two of you have followed. You can see the complacency on the left side of the chart. Up we go. There's that ECB crisis, and then things have improved here a little bit. Bill Gross, his Greece attempting recovery allowed you to finally purchase peripheral Europe paper. Are you buying the paper of Portugal, of Spain, and of Greece?
Oh, for the most part, we're void in those particular countries. Each of them has a respective argument relative to their economic progress going forward, but for the most part, in total, you know, the peripheral countries have too much debt. They are being floated by ECB term financing, by ECB purchases, and by that SIV that stands in readiness, supposedly at $500 billion. Ultimately, though, the economies, you know, must grow as opposed to shrink, and the fiscal austerity that's being imposed on them, you know, it stands little chance of helping them to do that.
And Dr. El-Erian, I think of your book, When Markets Collide. Okay, great. They collide. Now we have institutions colliding in Europe. Who should lead the way here on a workout? We have austerity and budgets. We've got institutions that don't want to get along. We've got a certain block of the ECB extremely tentative about a reflation or a quantitative easing. Who should lead the way here?
I think what should lead the way, Tom, is just a recognition of where we are. So if you summarize what you just said, what Bill just said, Europe has three distinct issues. One is certain countries have debt overhangs, particularly in the peripheral European economies. Secondly, there's a growth issue. Certain countries, again in peripheral Europe, are having enormous difficulty growing. And thirdly, there's a political issue. There's a limit to how long people can withstand austerity and tolerate it. So the critical thing is to have leadership as to how we're going to deal with the overhang, how we're going to get peripheral Europe to grow again. And that leadership has to come from Germany. Germany is the most important economy in Europe, and people will look to Germany to provide that leadership. If
you're just joining us, folks, Surveillance Midday, Bill Gross and Mohamed El-Erian with us. And what we love here is to bring a lot of smart people together. Think of Barry Eichengreen out at Berkeley writing an essay earlier this week on coordination of all the banks. And then this morning I went to Charles Wypols of the International Center for Monetary and Banking Studies on Bloomberg Surveillance, and I asked him about global coordination in central banking.
Central bankers, as you know, keep talking to each other, and they share a lot of common views. There is this threat of currency wars, which would occur if the major central bankers would not coordinate their actions in some suitable way. And these are reasonable people, so I think it's a possible arrangement.
And a lot lot of this, folks, all this international economics and what does it mean for America, particularly as we go to election. Bill Gross and Mohamed El-Erian, when you hear Professor Weipolz talk about that, when they talk about this hope and a prayer, I've yet to have a single person saying this is valid. Bill Gross, is there any hope that the ECB can get together with the Fed, can get together with the Bank of Japan?
Oh, I think those days are gone for the most part. I mean, that was crisis 2008 and early 2009, and now each central bank is sort of working on its own to salvage its own the constituents, so to speak. Japan is basically quantitative easing or trying to depreciate its currency. The UK is about to do a QE program. The United States, we think, in November will embark on another QE2 program, which in effect prints dollars. And so each of these central banks has their own policy in terms of trying to support their own economy, in this case via devaluation and lower interest rates. In the case of the ECB, not so much.
Look, gentlemen, and just because of time here, I want to switch gears. Bill, you have written eloquently on Fannie and Freddie, and Mohamed, I know you've thought about this as well. Mohamed, within your book, When Markets Collide, you talk about focus on the serious issue. What is the big, immovable issue we need to focus on with these troubled housing agencies?
It's part of the bigger issue, Tom, which is the U.S. faces a structural challenge, not just a demand cyclical challenge, but also a structural challenge. Fannie and Freddie have outlived their useful purposes in terms of the housing markets, but you can't just assume away the problem. You've got to deal with it, and you've got to use them to help restart the housing market. If we do not have the housing market functioning again, the consumer will continue to be under this gravitational force of the debt overhang, and it's going to be very difficult to get high growth generated.
I mean, and Bill, you talk about the gravitational force here, and there can be criticisms that Pimco is so large that you're manipulating to get something done within the agency area with all that bonds. What do you want to see out of Washington to help our viewers clear the housing market? What do you need to see to jumpstart or to break away from that gravitational force?
Well, my suggestion, and it's sort of aside from Pimco's endorsement, but my suggestion back in Washington was to allow refinancing for 5 and 6 and 7% mortgages that are underwater and that aren't allowed at the moment to refinance. That would do several things. One, it would lower interest payments for homeowners, and second, it would support the homeowner within its own home as opposed to kicking them out on the street and allowing for increased foreclosures. You know, as to the government's support or our connection with the government in terms of Fannie and Freddie, we really don't care from an investment standpoint. If Fannie Mae and Freddie Mac aren't attractive from an investment standpoint, then there are treasuries, plenty of treasuries to buy on the other hand.
Mohamed, you and your colleague are starting up an equity division as well. What's going to be the return that we should expect from equities in the coming 10 years?
Tom, I think that is a very partial question. What I'd like is ask is, why are we starting an equity division? We believe increasingly, as the world changes, as we evolve on this bumpy journey to a new normal, our clients are going to be looking for solutions, for holistic solutions that both generate returns and allow them to manage risk better. For Pimco to continue to be relevant to our clients, for Pimco to continue to deliver to our clients, we need to be in different spaces that constitute an overall solution for our clients. And that is why we have entered the equity space, and that is why we intend and are already delivering Pimco quality in our equity products.
You know, I got to admit, this just actually went into my puny little head here with all that's spinning on in economics, finance. Both of you look very presidential today. The ties look they look very White House, don't you think? I think it's break exclusive. Bill Gross and Mohamed El-Erian look presidential. What was that about last week? Where did this come from?
Well, rumors get started and rumors basically disappear. Mohamed and I guess we're both flattered, but let me tell you what we've got. Mohamed's got a squirt gun at his desk, and I've got a squirt gun on my desk, and we point them at each other and say, "Don't you dare."
Oh, good. Thank you so much, Mohamed El-Erian and Bill Gross of Pimco.